Hello and welcome to BQ Prime. You're watching Earnings with BQ, and my guest today is from Lupin, Ramesh Swaminathan, ED and CFO at Lupin. Ramesh, thank you very much for joining us on BQ Prime. To begin with, a good set of numbers coming on from you, especially sales 21% up. What were the drivers for this sales growth in the second quarter?
It's actually been secular, but hugely driven by America. As you know, we have actually lined up a pipeline of products to be launched out there. So this particular quarter was driven by, in fact, the Spiriva launch itself. So last quarter, for example, we also had Darunavir. Some tailwinds of Darunavir still persist, but for sure it is essentially Spiriva which carried the day. And that actually led the way. But there was also good growth coming in from Europe. Essentially, we had Foster, the generic equivalent, being launched and being actually ramping up in UK and various other parts of Europe as well. In general sense, you also find that after a weak Q1, you'd find South Africa ramping up, which happened. We also had a good performance across Philippines and the like. So I would say India region, of course, grew by, in line with the market at 6.9% and the like. So all of this was essentially, all of them kind of contributed for good growth across.
40% jump in North America market led by Spiriva. Can you give us some more color on the kind of sales that Spiriva did? What kind of market share is gaining? How is it going there?
We don't deal with into product-wise details and the like, but I would say that it's actually faring very well for a product which doesn't have generic competition. Could actually have steam for several more quarters to go.
What about Diazepam? That's also something that you launched, but I guess the momentum would pick up in Q3, Q4 for that, right?
Yes, I would imagine that. And there's a host of other products also, right? So from our perspective, Suprep, had a good run over the last, few quarters. So that's come up very well. In a general sense, I think, there has been stabilization of prices in America, and that's helped tremendously. That I think is a fallout of the fact that a lot of companies have kind of shed their portfolio, and the rising interest rates have also meant that a lot of companies, a lot of factories are closed down and the like. So there is, in a general sense, some shortage that you see across various products in America. So that helped us quite a bit. But apart from that, of course, the dominant theme has been, the kind of products that we launched out there.
Give me a sense of the kind of growth now that you see on a full year basis and the margins, because you got good healthy margins at 18.7% in the second quarter. Do you see closing the year at that kind of level?
Okay, first let me talk about, in fact, the growth, and that I think, we speak about, everybody has been anxious about touching the $200 million mark in America on a consistent basis. And I think that's something which is here to stay. Last quarter was 183. It rose this quarter by a good percentage. So from my perspective, given the portfolio and the like, the run is here to continue. And I would say that's true with, in fact, product, the portfolio in Europe and potentially, and of course, India. Indeed, we added, a good 1,000 people in the fourth quarter of last fiscal. And we expected that to kind of deliver results, and which is indeed the way it is. In terms of the margins, I think it's, of course, the dominant theme, of course, has been the top line because of the products that we launched. But it's also, an issue of execution across various of the lines. As you can imagine, it was the mix which led to, in fact, the gross margins. But if you see that there has been all-round development across cost lines, the entire P&L, so to speak. The workforce planning exercise that we carried out sometime last year in terms of factories, in terms of R&D and the like, reined in the overall manpower costs. We also kind of identified a host of things which were, eroders, retarders from our perspective, inefficiencies that kept into the system, which we wanted to address, in terms of idle time, in terms of inventory write-offs, in terms of failure to supply issues, then returns and, products that we had to kind of air freight. So we worked on those, and all of those, there's been pretty good results coming up. If you look at, in fact, R&D, it has pivoted to more complex products. Though, of course, the magnitude of spend is more or less the same as a percentage of sales. It's coming down a bit, but it's still, what it should be really. We had also had, in fact, the benefit of the PLI schemes announced by the government. All of that actually meant that things were looking up for us. We had promised that by the end of the third quarter you would see the margins perking up, and we said the closing run rate would be around the 18% mark for this current fiscal. We have been working very hard to kind of over deliver on that, so we were able to achieve it in the second quarter itself. And and if you look at, for example, there are some newer businesses that we had started adjacencies in terms of diagnostics, in terms of digital and the like, which of course are still in ramp up mode. There is a lot more expenditure associated with that. And if you were to knock that out, you would actually see another 60 basis points, at least for this particular quarter. So all said and done, I think the margins are faring very well, and of course will continue to do so in the days to come.
For the full year, will you end up at around 18% odd?
I wouldn't like to pick myself to a particular number. The fact of the matter is, we would like to kind of underpromise and overdeliver, and clearly it's evident in the way we have gone about it in the last several quarters. We would like to maintain this trajectory over the next several quarters. If you compare us with, in fact, the peer group, we are still a tad below them. Much below them, so to speak, essentially, and our aspiration would be to be consistently delivering over 22-23% at the core level, and that should be, in fact, the way we should be thinking about it.
Give me a sense of, you briefly spoke about air freights and all. I was listening to your peers and they were talking about the air to sea freight mix changing in favor of sea freight because the rates have fallen drastically in sea freight. Have you also seen that, and have you also changed the mix accordingly?
Yes, that was the intention. So during, in fact, COVID and during the times that we actually had problems with the factories and the like, there were supply chain inefficiencies of various kinds which had crept in. There was a lot more reliance on, in fact, air freighting. So of course, freight rates, ocean freighting has certainly dropped, as in fact the air freight. But there is, of course, unexpected surge in certain products, which actually meant that we had to kind of air freight it across. Spiriva, for example, and there's increased volumes also. But we are doing justice to what we are trying to do from a distribution perspective. Air freighting certainly happens only when it is actually the last resort, for the fact that we had to Russian supplies into America. But yes, the tailwinds are certainly there when it comes to the rates applicable to that particular.
Has the rates fallen really by 60 to 70% on a year-to-year basis for ocean freight?
I wouldn't, there of course been a decline in rates and so on. I wouldn't like to peg myself to any particular number. But the fact of the matter is, rates have been tending down, not merely on the freight front, is also across various input costs, as API, in the case of raw materials, chemicals, and the like. Some of these are still holding up, as in the case of excipients, because the dominance of Europe, and given the geopolitical tensions out there, it is still prices are fairly high from a 2019-2020 perspective, so to speak. But I would imagine that will also get it will sort itself out over time.
What about the price metrics in the US market? Are you still seeing some pressure on the price erosion coming in there? Except for the new launches which you have come in, the old product launches which have happened, have they stabilized with respect to pricing?
That's an interesting perspective also. Essentially, as I said, when it comes to newer products, obviously the realizations are pretty high, and you don't associate themselves with in fact, price erosion. But if you look at the inline portfolio of products, there has been a lot more stickiness in the recent times. Price erosion is down to a single digit number, principally because of various reasons. As you said, there are shortage of products in America, fallout of, in fact, the lot of companies pruning out on their portfolio, closing down of factories and the like, and so on. So in a general sense, I think there's a lot more stability today than I would have said in the recent past.
How about the API segment? Because you got good growth coming in there, but I think global institutional business was driven by anti-TB and ARV sales, right? So was it one-off that's coming in, or it's a consistent demand now started coming in for those kind of products?
Well, in terms of cephalosporin products, Pen-G prices are still ruling very high. But that said, during the COVID times, I think the entire acute therapy, did take a hit, given the fact that people are not moving out and flu season was not as prevalent and the like. That impacted really our entire cephalosporins, range of API that we were bringing to the market, which is in fact our biggest, contributor there. So in recent times, you find, of course, 7-ACCA to have picked up and so on. Whilst Pen-G prices, are still ruling pretty high from my perspective.
In the India business, I think you grew at 8.9% odd ex NLEM. What was the impact if you bring in NLEM into it?
As I said, without, if you look at, in fact, the figures pre-NLEM, compare that, so if you remove that impact, it was 6.9%. Considering, in fact, the NLEM impact, it's 8.9%. But I think the moot point is the fact that how are we faring on, various therapy areas where we are particularly dominant, which is the cardiovascular space, the respiratory space. You could also talk about GI and women's health in the same space. Doing very well. We service the market, and are very pleased with the performance. On the diabetes, because of the fact that, there have been a couple of LOEs that we lost out on, because of that, the overall, the growth rates are a little, stunted, so to speak. But in a general sense, given the, the influx of about 1,000 people, and the greater penetration that we expect at the market, the intensity of calling on doctors and the like, the productivity is set to increase, and I would imagine we'll be able to kind of sustain growth rates of well over 30%, 30% over the market rate, so to speak.
I just want to get your thoughts on albuterol market share 22.9%, which looks very good. Will you be able to sustain that? Is there a pricing competition coming in that area?
Generics is all about actually competition at some point of time. The going is pretty good for us, so the competition has had some problems in recent times. So we have kind of capitalized on that, but hopefully we'll be able to sustain this over the long term as well.
So is the case with arformoterol as well?
Yes, you're doing very well in the respiratory portfolio. And we have pivoted, to, in fact, more complex ones. So if you look at, in fact, our turnover in America, close to about 40% is essentially, more complex ones led by, in fact, respiratory. And we see that sustaining and only growing in the days to come.
Just wanted to get a check on this. Your capex to sales ratio, it's come down to 2.5, 2.7. In the last few quarters, it has been around 3.7, 3.8%. Are you going to go back to that? What kind of capex are you looking at?
So there are two parts, so we have been sweating our assets a lot more. And if you look at the fixed assets to turnover ratio, that's been increasing over the last several quarters, so to speak, and that, I think, is the way it should be. We did mark, highlight the fact that there is considerable idle time that we had, and we have been working on that, so one of the moves was, of course, to look at, in fact, spinning off a couple of factories to a CDMO, foray, so to speak. So that is insofar as the overall capacity utilization and potentially what I've been doing on idle time, the footprint and the like. You, of course, went in for workforce planning, if you can recall, in that connection, really. But speaking about capex itself, I don't see too much of expenditure coming in that, because essentially the capacities are already there. You might build something for, as and when particular therapy areas really take off, or dosage forms really take off, as in the case of, say, injectables and the like as well. But for sure, at this stage, it's going to be low, capex mode, so to speak. And we'll wait for, in fact, the demand to grow, to surge before we invest more.
Finally, an update on some of the sites which are under warning. Where are we on, getting them back on stream? This Tarapur and Mandideep 1.
The good thing is that, we had 5 such instances not so long ago, but since then at least 3 of those have been resolved. Principally Tarapur, if you look at Somerset and it's Somerset and then our Goa and Pithampur. What is still pending is essentially Tarapur and Mandideep 1. But it's a question of time, because I think we are in a state of preparedness. We've done what it takes, and it's a question of time before those get resolved as well.
Do you have any timeline on when the next inspection is going to be there?
It's difficult to actually foresee that, but I would imagine it is going to be imminent.
Okay. Ramesh, it was a pleasure talking to you today. As always, after the quarterly earnings, thank you very much for joining us on BQ Prime.
Thank you very much.
Wishing everyone a very happy Diwali. This is a year when India has done very well and is poised to do well for a long period of time. So hopefully this will be a truly prosperous Diwali for everyone.